Hey everyone, and welcome back to The Explainer. Today, we are diving into something that is literally massive. We're looking at what experts are calling one of the biggest potential financial events in history. In the coming weeks and months, tech absolute giants, companies like SpaceX, Anthropic, and OpenAI are gearing up to go public in a series of mega IPOs. But the way these public offerings are being structured, well, it might directly involve your own retirement account.
So let's just cut right to the chase with a really provocative question. Is your retirement account being used to bail out the biggest AI bubble in history? Now, I know that sounds like a crazy conspiracy theory, but it's not. This is a deep dive into how the underlying rules of Wall Street are shifting right under our feet. The actual mechanics of the financial system are being rewritten in a way that practically forces passive funds, the exact kind your 401k is probably invested in, to automatically buy into these massive sky-high tech valuations.
Okay, let's jump straight into part one. The $4 trillion exit strategy and the sheer scale of these incoming mega IPOs.
Because we are talking about mind-boggling numbers here. Combined, companies like SpaceX, OpenAI, and Anthropic are looking at a valuation hovering around $4 trillion. They are preparing to leapfrog essentially every other company in America on day one. To put this into perspective, SpaceX alone is aiming for a day one valuation of $1.75 trillion. That would make SpaceX more valuable on its very first day of trading than every single American defense contractor combined. It would literally be the biggest initial public offering in human history, totally blowing past the record held by Saudi Aramco.
But here's the catch, and it's a big one. When Saudi Aramco went public, it was the most profitable company on Earth. SpaceX? Well, last year they operated at a net loss of $5 billion. Yeah, negative $5 billion. So you kind of have to ask, how exactly does a company losing billions of dollars pull off the biggest public valuation ever? Well, it all comes down to two words: exit liquidity. Basically, the early insiders who bought into these companies way back when, they want to cash out and walk away with their profits. But to do that, they need buyers. And finding voluntary buyers with enough active cash sitting around to absorb trillions of dollars of stock at peak, record-breaking valuations, it's essentially impossible. The money just isn't there. So the only buyer big enough to absorb all of that supply is the passive investment complex. We're talking about the trillions of dollars sitting quietly in mandatory index funds and everyday 401ks.
Which brings us to part two, rewriting the financial rules and exactly how the NASDAQ is basically guaranteeing this mandatory demand.
So, if you want to force passive funds to buy your stock, what do? You get your company into the index. Getting added to the NASDAQ 100 is essentially a license to print money because over $600 billion in passive funds are legally forced to automatically buy your stock. They literally do not have a choice. Now, getting into the index used to be hard, but on May 1st, the rules got a very convenient little firmware upgrade. First, they introduced a fast entry rule, cutting the wait time from a year down to just 15 trading days. Second, they lowered the float requirement. And third, they slapped on a 3x multiplier. That artificially inflates the stock's weight, so those index funds have to buy triple the actual available supply. Wild, right?
Just to make sure we're all on the same page, let's talk about that second point, the float requirement. The float is just the percentage of a company's total shares that the general public can actually buy and sell. The NASDAQ used to strictly demand a minimum 10% public float to get into the index. But SpaceX is reportedly planning to list with only a 4 to 5% float. Under the old rules, they would have been disqualified instantly. But under the new rules, the path is completely cleared, right in time for these AI mega IPOs.
Let's move on to section 3, unpacking the AI dream and deconstructing the SpaceX business model.
Investors absolutely love to buy the dream. And exploring Mars or revolutionizing the world with artificial intelligence, it's a super compelling story. But as focused learners, we have to look past the hype and look at the actual financial reality. If we peel back the layers on SpaceX, we're really looking at three totally different businesses. You've got the rocket business, bringing in about $4 billion in revenue, mostly from the government and NASA. Then you have Starlink, which is an absolute powerhouse doing $11.4 billion in revenue with massive 63% profit margins. If it was just those two, SpaceX would be printing money. But then there's the third unit, xAI, Elon Musk's artificial intelligence branch. xAI is burning through over $1 billion every single month. That one single branch is basically dragging the whole company down to that negative $5 billion loss we talked about earlier.
All right, section 4, the circular accounting loop. This is the Pokemon card illusion propping up big tech.
So if the actual profits are bleeding out, why rush a $4 trillion IPO right this second? Well, analysts are pointing out that these massive tech earnings we're seeing right now might just be propped up by a crazy accounting trick. Think of it like this. Let's say I lend you $100 to buy a rare Pokemon card. The card value shoots up to $1,000. I write down on my taxes that I made $900 in profit on paper, and then I use that paper profit to justify lending you $5,000 to buy even more cards. It's a loop. Big tech issues corporate debt, they invest those billions into AI startups like Anthropic and OpenAI, and then those exact same startups use the investment to rent computing power right back from the big tech companies. Big tech books that circular money as profit, which makes their earnings look incredible, which then justifies issuing even more debt to do it all over again.
But here's the reality check. The Financial Times actually ran the numbers on this. They assumed zero overhead costs, literally the most generous assumptions possible. And the implied return on this massive AI investment is pretty startling. Amazon is barely eking out a positive 7.2%. Microsoft, negative 9.2%. Oracle is sitting way down at negative 35.6%. Think about that for a second. Almost none of these tech giants are projected to make a positive cash return on all this massive AI infrastructure they're building.
Let's hit Section 5, Macro Threats and Squeezes. Here is why the IPO window is rapidly closing. You see that circular accounting loop? It really only works as long as the overall market stays strong and everyone just agrees to believe the paper valuations. But the geopolitical and macroeconomic realities are threatening to snap that loop in half. That is exactly why there is this frantic rush to push these public listings through the window right now. A huge warning sign flashing is something called negative market breadth. This happens when a stock index hits absolute record highs, but all of the gains are driven by just a tiny handful of massive companies, while the vast majority of regular stocks are actually dropping. We recently saw the S&P 500 hit 4 consecutive record highs on negative breadth. According to analysts, that has literally never happened before in the history of the market.
And this is where it hits home for you and your retirement. If your standard 401k tracks the S&P 500, take a look at how insanely top-heavy this has become. 49% of the entire market cap is concentrated in just 41 AI-related companies. The other 459 companies make up the remaining 51%. So basically, nearly half of your entire retirement account is just one massive, highly concentrated bet on a very specific AI thesis.
And let me tell you, that concentrated bet is incredibly fragile right now. For example, energy executives are warning that geopolitical conflicts in the Middle East are pushing oil inventories to critical lows. Let's say oil spikes to $150 or $160 a barrel. Oil importing nations are going to be forced to sell off U.S. treasuries just to get the dollars they need to buy that oil. When treasuries are dumped, treasury yields spike. And when yields spike, corporate borrowing costs shoot through the roof. Suddenly, the billions of dollars in debt that is fueling this whole AI spending boom becomes way too expensive to maintain.
Which brings us to our final part, Section 6. When technology wins, investors lose. Because history doesn't repeat itself, but it sure does rhyme.
Now, I want to be super clear on what the sources are saying. AI is completely real. It's an absolute game changer of a technology that will likely change the world. But historically speaking, a successful technology and a successful investment are very different things. Think back to the late 1800s with the railroad boom. It completely transformed American commerce, right? But almost all the initial investors went totally bankrupt before the industry actually stabilized. Same thing in the 1990s with the fiber optic boom. They successfully built the physical backbone of the internet we use today, but the companies that laid the cable crashed and burned during the dot-com bust. And today, we have the AI boom. Trillions are being spent, but history tells us pretty clearly that the people paying peak valuations early on usually get wiped out.
And this right here is the absolute core takeaway we need to pay attention to. The initial investors absorb the losses so the next era can be built. These massive mega IPOs, they aren't necessarily about these companies needing cash to build the future. The rules are changing because the early insiders need an exit liquidity event. They need a buyer before the music completely stops, before the accounting loops break down, and before the macro environment completely crashes the party.
So that leaves us with one really crucial, provocative question to think about. If the AI earnings loop breaks, is your passive retirement account going to be the one absorbing those trillion-dollar losses? As focused learners, it is absolutely vital right now to actively review what your index funds actually own and what they'll be forced to own soon before these new Wall Street rules fully take effect. Thank you so much for joining me for this explainer. I hope it gave you some real food for thought. Keep learning, stay curious, and I'll catch you next time.